You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have JD Sports, Airtel Africa, Imperial Brands, Pershing Square, Direct Line, and our US company of the week is Workday. Sam, shall I kick us off with JD Sports' third quarter trading statement?
Yes, how are they doing?
So JD Sports organic sales growth slowed to 5.4% in the third quarter, down from 6.1% growth seen year to date. Performance was mixed as growth slowed across North America and Asia Pacific, whilst decline narrowed in the UK and growth improved slightly in Europe. A strong start to the quarter, helped by back-to-back school sales, was offset by trading volatility in October as promotional activity increased in the sector. Its acquisition of the French brand Courier is set to complete shortly as all regulator conditions have now been satisfied. Full-year pre-tax profits are now expected to be at the lower end of its previously lowered 955 to just over £1 billion guidance, and the shares fell by 13.7% in early trading. In terms of valuation, JD has a market cap of just under £5.3 billion and trades at 7.6 times forward earnings, compared with a 10-year average of 16.3, and has a prospective dividend yield of just under 1%. I thought these results were disappointing. I know it's a huge growth market in the sort of sports apparel sector, but I think we've talked about it before, and one of the concerns, I think, on the back of these slightly poor results is the direct to consumer sales from the big, the big names in sportswear, Nike and Adidas. Currently, they've got good relationships with Nike, but when we covered them, we've seen that percentage of direct to consumer increasing. And they're currently Nike's single largest partner globally. But I think that's a concern going forward for JD. I think coming to the valuation, though, some of that is reflected, and it's certainly a lot cheaper than it has been trading at in recent years. So whether the market is taking a view on that and seeing growth slower and that potential threat there in that valuation, potentially, it would be enough to put me off buying shares.
I don't know how I feel about this one because we've covered it for a while. We've both been concerned about the direct consumer, and I think long term that's where Nike and Adidas want to go. But equally, we've had quite a few people come on for interviews who've made quite a strong argument for it. They are expanding quite aggressively in the States. I think the 5% organic's still pretty good. When you think about it, it's a sports store and it's still organically growing. I think 5.4% is actually pretty decent, especially given the size it's already at. I think the valuation's pretty reasonable in that forward PE of 7.6, especially considering it's below half of the 10-year average. I mean, it's like when we had Flying Finance on back in, was it? Yeah, it was back in the summer now, but he was saying, well, you go in there now and there's a lot of like newer brands like Nike and Adidas seem to not have the dominance they had maybe 10 years ago. There's a lot of like Skechers and he named some other brands I don't know. I'm not that hot on trainers. I can sort of see where they're coming from, but equally, I think the concerns that we've had for the past few years, I think long term aren't going away. So I think if you believe in the business, it probably is quite a good opportunity. And I don't think it's going to disappear. And it might have to refocus, like kind of reposition itself. And it might be different brands in there in 10 years' time. And you might not have the Nikes anymore because they might just trying to be selling them all to you themselves. But I think it's a very reasonable valuation for what is a very well-run business because I think although it's a huge threat to them, there's nothing they can do about it in terms of they can't control what Nike and Adidas are going to do, but I think they are positioning themselves well for the future. And I think it has historically been a very well-run business. I think it's very, very cheap, but for me, those long-term issues are there. And then there's just the fact that it would take a lot for me to buy what is essentially like another retail business. I don't think I want I don't really want the retail exposure. I think that's always just something that I'm a bit wary of now, having been burned in the past. Although this is definitely a higher quality business than Boohoo. But I think for people who were already liking it a year or two ago, I don't think these figures are absolutely terrible. I don't think anything significantly changed, but equally, I think if you already had some concerns, I don't think there's anything in here, even though it's gotten cheaper, that would say, yeah, let's pile in.
It'll be interesting to see, though. Continue to follow it. Okay, on to one that we both own then, Airtel Africa.
Yes, so these results are about a month old. However, we did have a listener complain on Twitter that we had
Oh.
not covered them. And I was like, at first I was going to ignore it. I was like, that can't be right. We must have covered them. And then they were right. I don't know how we missed them, but yeah, we've not covered Airtel Africa's latest results, for which we do apologise. So these were released on the 25th of October, and they're for the half year ended 30 September 2024. So revenue was down, and these are all in reported currency, and these figures are in dollars. So revenue was down 9.7% to 2.3 billion. Operating profit was down 20.3% to 700 million. Profit after tax was up 726% to 79 million. I think that's just because they'd lost more money on the Naira devaluations in the previous half than they did this time. Basic earnings per share is up 156.4%. Net cash from operations was down 12.7% to 979 million. And in constant currencies, they've said that revenue grew 19.9%. So it's down 9.7% reported currencies, but if it weren't for currency movements, it would have actually been up 19%. With growth accelerating to 20.8% in the second quarter, and that's been driven by an acceleration of growth in Nigeria to 38.2% and in Francophone Africa to 9%. Across the group, mobile money services revenue grew by 18.4%, and mobile money revenue grew by 28.8% in constant currency. Reported currency revenues declined by 9.7%, and they've said that reflects the impact of the currency devaluations, particularly in Nigeria. They've said a substantial increase in fuel prices across our markets and the lower contribution of Nigeria to the group after the Naira devaluation contributed to the decline in the EBITDA margin to 45.8% from 49.6%. Profit after tax of 79 million was impacted by 151 million of exceptional derivative and foreign exchange losses arising from further depreciation in the Nigerian naira in the period. I would say at this point, they're still treating it as exceptional in the accounts. This is like the third or fourth time we've seen this in the results now in the last sort of 12 or 18 months. I think we are now at a point where you can't be stripping it out. This isn't exceptional anymore. I think we just have to assume this is going to continue. Well, that would be my view. So I do object to the use of the word exceptional here. And earnings per share before exceptional items declined from 7 cents to 4.9 cents, primarily reflecting the translation impact of currency devaluation. In terms of the operational highlights, the total customer base grew by 6.1% to 156 million. Data customer penetration continues to rise, driving a 10.4% increase in data customers to 66 million. Data usage per customer increased by 30.9%, and smartphone penetration increased 5.3% to 42.9%. That means there's still about 58% of people don't have a smartphone, which I think does reflect the opportunity. Mobile money subscribers increased by 13.4% to 41.5 million, and that reflects their continued investment into distribution to support increased financial inclusion. Transaction value increased by 30.1% in constant currency, with annualized transaction value of 128 billion. The data average revenue per user grew 13.5%, and the mobile money average revenue per user grew 10.9% in constant currency, and continue to support overall average revenue per users, which grew 11.1% year over year in constant currency. In terms of the valuation, there is no longer any earnings because of the currency devaluations we've had recently. I've not really gone and tried to find an alternative. It's probably trading at a normalized PE of something like 8 or 9. It was always incredibly, incredibly cheap when it had earnings back in the good old days, and it's currently yielding about 4.5%. My view is, in terms of the performance of the business, very happy with it. They can't do anything. What's really shafted them here is economic factors that are totally outside of their control. That being said, although I'm very happy with how the business is performing, I don't think these issues in Nigeria are going away, in that there seems to be a pattern that has developed now. I think if you're continuing to hold the shares, you are doing so on the basis that these currency devaluations are going to continue and you're okay with it. I think I am okay with it because I think the way they're responding to it and the way they're growing other parts of the business. So, for example, there was only actually one segment of the business that grew in reported currencies, and that was mobile money, which is the part of the business we're most excited about anyway. But I think what will happen is hopefully the rest of it will grow and the mobile money will grow, that these issues with Nigeria aren't affecting the earnings as much anymore. And if it comes back and it stabilizes a bit, that's just a bonus. But I think fortunately it was already cheap enough that this hasn't significantly affected the share price. I think it's lower than it was, but it's pretty similar to I think the price that we bought in at. And this was a risk that we were aware of. And I think if you continue to hold at this point, it's a risk that you're happy with this continuing, would be my view. In terms of my own position, I'm happy with the performance of the business. I still think there's huge potential for mobile money. I don't think my thesis has actually changed from when I bought it. I think what's been happening in Nigeria, it's unfortunate that Nigeria is the biggest market that it's happened in, but this could have happened in any one of the markets because of how sort of fragile some of these economies are that they're operating in. So this was a known risk when we invested. I think they've responded as well as possible. I don't think I'll be adding to my position despite the share price coming down quite a bit in the last 12 months, but it was already a decent sized position and I certainly won't be selling. So I'm quite happy to continue holding with these results. What do you think, John?
Yeah, very similar. I would just echo what you'd said essentially, and happy holding. It has been a little bit of a roller coaster, but these were known unknowns when we went in, and you were braced for some volatility. And I don't think it was ever going to, it was ever expensive. And I think that was because of, despite the growth, the nature of the markets it operates in.
I think as well, I know I've already said it, but the core business itself is performing well. And if we were to take another business that we've covered on the show, PZ Cussons, that's also been massively affected by the issues in Nigeria because that's one of their biggest markets. But then you look at the underlying figures and they're not good. And I think
Yeah,
that for me is the key difference. It's not if the business wasn't performing and you had this on top, it would be like, oh,
yeah,
what do I actually own this for? And I think as well in the longer term, you would hope that with all these tailwinds economically and stuff, like when we talked about the penetration only being at 42% for smartphones, there's a huge, huge opportunity. And I think the currency issues might delay it, but I think in the long term, I do still think there's a huge potential for the earnings to increase, although we do need some earnings for that.
yeah, yes. And hopefully they'll be coming back soon. Okay, on to Imperial Brands then. So it's a business that we've covered quite a few times on the show. It's the second largest tobacco company listed in the UK, with brands including Golden Virginia, Lambert and Butler, JPS, Davidoff, and they have the blue brand of e-cigarettes. Anyway, they had their full year results out with Imperial Brands underlying tobacco and next generation product revenue growing by 4.6% to £8.2 billion. And this was driven by a 26% growth in the next generation products, the e-cig sales, and strong pricing in tobacco, which more than offset a 4% decline in volumes. Underlying operating profit grew by 4.6% to £3.9 billion, in line with prior group guidance. Free cash flow was flat at £2.4 billion, and underlying net debt fell from £8 billion to £7.7 billion. The annual dividend was raised by 4.5% to just over 153 pence a share, and there is an ongoing £1.25 billion share buyback, which is expected to be largely completed during this financial year. This year's tobacco and next generation products net revenue is expected to grow at low single digit pace, and underlying operating profit is expected to grow in the mid single digits. And the shares were up around 3% in early trading. In terms of valuation, Imperial has a market cap of £21.5 billion and trades at 7.5 times forward earnings compared with a 10-year average of 9, and it has a prospective dividend yield of 6.8%. I thought these results were decent with volume declines of only 4%. I think we've been getting slightly used to it nudging past the 5%. And as we've seen with British American, continued next generation product growth. I think it's also interesting because we've talked about the strategy of the companies, and Imperial Brands has really taken what you've particularly commented on, Sam, and returning as much cash to shareholders as possible. And if you look at it from the trading update last month, Imperial has announced their plans to increase the share buyback by 13.6% to the 1.25 billion next year, as I mentioned earlier, along with dividends for the full year of just over 153 pence. And that represents, from the start of this strategy in around January 2021, around £10 billion of capital returns, which is around 67% of the market cap when they started the strategy in January 2021. So a huge amount that's been returned to shareholders. And I suppose what the age-old question with Imperial Brands is, what is the future with it? And given that the core tobacco industry is in structural decline and we're continuing to see it, is the investment case essentially that even if that goes to zero and there isn't a future in the vaping products, would investors essentially have received enough in dividends to more than compensate them for the loss of, I suppose, their initial capital that they've invested? And I think that's something that you've believed in, Sam, and also that you think there's a future there for the vaping anyway. What's your take on it after seeing these most recent results?
I think the results are excellent. I think we kind of accepted we might have to get used to 6 or 7% volume declines going forward. It seems to have accelerated, and that seems to have now gone back down to 4%, which is what we were used to seeing, which is just excellent. And I think even at 6 or 7%, you could make a solid argument that you would get your capital back anyway. I mean, what you said about the 60 or 70% since 2021 is just absolutely bonkers to have had that much of the market cap back. But then as well, in the last 3 years, the shares are actually up 64%.
Hmm.
So as well as having 60% of that original market cap back, you've actually made another 60% on the shares. It's just kind of bonkers, really. And then they're priced so low, it's priced as if it's going to zero, which I think did used to be a fair assumption. But I do think with these next generation products, they're going to be left with something. I don't know what, so maybe it is easy to just assume it will be zero. But I don't actually think it will be zero. I know I'm contradicting myself a bit there, but it's going to, I think there is going to be some value left in this business at the end. And the end seems to be still quite far away, could be a generation away. If you're getting 7 or 8% of your money back a year, I think you're pretty likely to do well. And the shares seem to have done quite well over the last few months, as have British American Tobacco, which I'm a shareholder in. But even still, they're not that expensive. And I do think the fact that they're not, I think the fact that so many ESG companies will just not include them and they are regarded as a sin stock, I think it does give the individual investor a huge advantage because I think there's a lot of funds that would normally have these in that aren't allowed to touch them, no matter how cheap they are and how strong the investment case becomes. Because it's like even now, it's like we're talking about what was it, 60% share growth in the last 3 years, 68%. And it's still only at a forward P of 7.5. So this is not an expensive stock. And I think these results are pretty good. And I think the next generation as well, because that's something where I think Imperial has lagged behind British American. I think 26% growth in next generation compared to what we're used to seeing from Imperial is very good. So yeah, I think overall it's a very good year for them.
Interesting. Okay, then. On to Pershing Square.
Pershing Square. So this is going to be a bit ranty, this one. So Pershing Square have come out with their third quarter results, and they are listed on the FTSE. So I kind of assumed they would have the same reporting requirements as all the other FTSE companies. I don't know if it's a bit different because it's a fund, but on the website, actually finding the results was nigh on impossible to the point where I almost gave up and was going to do something else. But fortunately, there is an article on institutionalinvestor.com which goes through the earnings call, which they did have last week or whenever it was, and it goes through the main points that were discussed. So we have covered Pershing Square before. It is a fund which is managed by Bill Ackman, who He's a very well-known investor. It's a very concentrated fund. It tends to be in US listed stocks, and he tends to have about 7 or 8 positions. He'll charge a couple of percent a year. I don't know exactly what it is, but basically what you're doing is you're paying for the privilege of having Bill Ackman manage your money, which, based on his historical returns, isn't the worst thing in the world, actually. But I'm just going to read straight from this article. So, like I say, it's from institutionalinvestor.com, so I'm not taking any credit for this, but said when Pershing Square CEO Bill Ackman first announced his intention to take a stake in an upcoming IPO of Universal Music Group in 2021, he admitted that he'd fallen in love with the company. But the hedge fund's manager's love affair with Universal Music has been somewhat tempestuous this year, costing him dearly. It's now quoting from the call. We're certainly an underperformer relative to the stock market, he told investors on the call, noting that one of the stocks holding back the hedge fund's performance is Universal Music. He said Universal Music, Pershing's biggest holding by several multiples, is down year to date approximately 14%. As a result, Ackman's publicly traded hedge fund is having its second worst year since 2018. The fund was only up 7.9% up to November 20, while the S&P 500 has been up over 25%. Moreover, the stock price of Pershing Square Holdings is flat to slightly negative for the year. In 2021, Ackman planned to invest some of the proceeds of his special purpose acquisition company, so SPAC, Pershing Square Tontine Holdings, in a partial spin-off of Universal Music from French conglomerate Vivendi. It was love at first sight, he told investors in the SPAC when the plan was announced. Universal was a perfect business, he said. It checked every box, so he dug in. The SPAC investors balked, and the SEC eventually stopped the deal, leading Ackman to invest $2.9 billion of his hedge fund's assets into the Universal Music IPO. He raised an additional $1.1 billion from other investors to come up with the total required to keep the commitment he'd made to Vivendi for 10% of the new company. At more than $4 billion, the investment dwarfs his other positions. The next largest is a $1.7 billion stake in Brookfield, and it says, to be sure, Pershing Square has profited from Universal Music over time, and Ackman said on Thursday that Pershing Square paid 18.3 euros per share for its stake, which comes in at $19.17, but Universal stock's currently trading below $22 a share on Amsterdam stock market, and Universal stock fell around 20% following its second quarter earnings this summer. At the time, Universal said its streaming and subscription business, which typically ran around 11% annually, has fallen to 4% for the quarter. During the third quarter, the metric rose to 6%. And earlier this month, Ackman went on, or last month now, Ackman went on X to propose a plan he thought would boost Universal Music's stock price. And it's quite ingenious, this plan. He wanted to move it from the Amsterdam Stock Exchange to New York, or the Nasdaq, which would allow it to become part of the S&P 500 and benefit from passive investment flows. I think he's not said this, but it would also benefit from the higher multiples that you seem to get generally in the US. And I don't think it's actually the worst idea in the world. So he said he's long wanted such a listing, but the other owners of Universal Music have wanted to keep it in Amsterdam for tax reasons. And Ackman claimed he has a contractual right to force the listing, but the company's denied this is the case. And in the call on Thursday, he's no longer mentioning moving it to the US. So quite an interesting story. That's how Pershing Square is getting on based on institutional investors' analysis of the call, but we couldn't actually get anything that resembled a set of results out of the website. So yeah, I just thought it was quite interesting just to see what Bill Ackman's been up to since the last time we covered Pershing Square. And I guess it's just quite a good, it does just highlight that concentration risk. I don't know if did you ever watch the Herbalife Betting on Zero documentary?
I didn't know.
So it was quite good, but it was a similar thing where he seems to have, he's done very well, so I'm not going to criticize Bill Ackman too much, but he seems to have a habit of getting a little bit too emotionally attached to his investments. So he had it with Herbalife, where he ended up going up. So I think he'd shorted it because he thought it was a pyramid scheme, and then started trying to bring the share price down by telling everyone he shorted it and it was a pyramid scheme. And then Carl Icahn, he took a big position longing it and then just made a load of money out of it. And it was quite a good documentary, but I think it's just quite an interesting article, and I think it does highlight the risk of running a highly concentrated portfolio. Do you have anything to add, John?
I probably don't. I mean, it's an interesting selection, I think, within that concentrated portfolio, and I appreciate with Universal, it's been difficult. But had you had any thoughts on some of the other holdings?
So I had struggled to get a list of the other holdings that was actually up to date.
Okay, fine.
So I got one from the summer, and I just thought I don't know how it's changed, because there was so little information published by Pershing themselves. But it had stuff like Howard Hughes Corporation. I'll just
Mm.
Google it because there's only like eight, so it's quite, I suppose it can't change that much.
Yeah, I think it's got Hilton,
Yes, it does have Hilton.
Restaurant Brands International, which owns Burger King, Tim Hortons, and Popeyes. Alphabet, which is parent company of Google.
Chipotle,
Yeah.
Howard Hughes. He's got Nike actually. That's an interesting
Mm.
one. And Canadian Pacific, Kansas. I don't know what that is. But I guess really, yeah, it's like I say, you're just paying for the privilege of having Bill Ackman manage your money. In terms of the valuation, because it is listed in London, it's currently trading at a discount of a third to the net asset values, which probably tells you how sentiment is towards Bill Ackman at the moment. I guess given that he's underperforming the S&P 500 this
Mm.
year. But if you were thinking of going and buying those some of those stocks yourself, it is actually a third cheaper to just buy Pershing Square rather
Mm.
than. Although I think it's pretty normal for these kind of funds to trade at some kind of discount. But
Discount, yeah.
shall we move on to Direct Line? What have they been
Yes.
up to?
Well, so we missed it out a few weeks ago, but it has been subject to a takeover offer. So I thought we'd go back and we'd have a look at some of the result or the most recent set of results. They had a Q3 trading statement out a few weeks ago, with the group reporting an 11.8% rise in sales over the first 9 months from ongoing operations to £2.5 billion. And that was driven by growth of 11.4% in motor and 12.9% in non-motor. Motor-owned brands delivered premium growth of 2.9% year-on-year due to higher average premiums, and total motor in-force policies fell by 5.9% since the start of the year to £3.9 billion, though the rate of decline in the third quarter eased and there was a 3% growth from price comparison site channels. Cost savings are projected to deliver around £50 million in gross savings in 2025, and plans are underway to reduce headcount by around 550. Medium-term targets were reiterated, which point to a 7 to 10% compound annual growth in sales over 23 to 2026, and net insurance margins of 13% in 2026. And the shares were broadly flat in early trading. In terms of valuation, the group has a market cap of £3 billion and trades at 7.8 times forward earnings compared with the 10-year average of 11, and has a prospective dividend yield of 8.6%. I mean, I thought these were positive results after a challenging time recently in the motor insurance market, which make up half of all the active policies, with some of the aggressive price hikes and new policies being written at levels with the net insurance margins of above 10%. As I mentioned before, last week there was takeover talk with an offer from Aviva at £2.50 a share, and that was cash and shares, which was near 60% premium, which had been put to Direct Line, and they have rejected that. And this was also on the back of takeover talks earlier in the year from the Belgian insurer Ageas. It's a business that I think since we've covered it has badly managed some of the insurance pricing for the motor industry, and I think they got things quite badly wrong. They have suffered, and it's resulted in a big dip in the share price. This may just be opportunistic from Aviva. But I suppose, Sam, the question that I would put to you is, what do you think of the current offer from Aviva? Do you think it's fair value? And if you were a direct line shareholder, would you be jumping at this?
I don't think I would. Because it's like when you go back, if you look at the share price over 5 years, it was consistently over £3 a share. And I know it's dropped below, what was it? It would have been probably about £1.50, £1.60 before the takeover offer started. And it's kind of it's spiked now and it's at £2.34. But I just think if you own the shares and you think management can turn it around, you're probably I think it's like I think it's quite opportunistic. If you think the earnings can get back to what they were in 2021, now you might argue that they probably shouldn't get back to what they were because they were actually writing bad insurance. So
Mm,
the earnings weren't actually at a sustainable level. But even still, I think it's pretty cheap, and that's why it's had so much interest. So if I was a shareholder, given that most of the shareholders are probably sat on a loss as well, I think my view would be, well, I'd want to if I believed in the business and the turnaround, why would you want to sell it? Unless you're someone who's just bought in, I'm not sure why as a shareholder you'd want to sell it and crystallize a loss when realistically I don't it's not a terrible business. It's having a bit of a wobble, but it's in quite a steady industry. It's a very good brand. I don't see why it wouldn't be able to get the earnings back to where they were in 2020 and 2020, maybe not 2021, where it was like the COVID year, because that was probably the best year they'll have. But in terms of back to historic levels, what do you think?
yeah, no, I would tend to agree with you. It does seem opportunistic, and so far the new management team are delivering on the numbers, and I wouldn't see a reason why they couldn't continue to do so. I think it's interesting that they're moving more into the price comparison market too, and I think that's probably a sensible strategy for them. As someone who's not a shareholder, obviously I don't have skin in the game, as it were, but I would probably feel that this does undervalue the business given the direction that things seem to be going in. So I would be inclined, if I were a shareholder, probably to hold on here.
Yeah, because I don't see why they wouldn't be able to get the earnings back to kind of pre-COVID levels. And it's like,
Mm,
2020, the earnings were 28p a share. 2021, they were 30p a share. Even with this takeover offer that's just pushed the price up, it's only at £22.30 a share. So if you thought they could even get to just back to 20p a share, and I think for
mm,
2024, they're already projected to get back up to 12p. But if you look get back up to 20p a share, which is only two-thirds of what they were in 2021, it still puts it at a PE of like 10 or 11, which
yeah.
is pretty cheap, especially as well, given it's historically, I think it's been cut, but historically it's been a pretty good dividend payer as well.
Oh, yeah.
And if the dividend comes back up to 5 or 6%, which it could well easily do, or 4 or 5%, I don't see why you'd sell it now at £2.30 if you're someone who has, liked the business at a higher price. But yeah, I don't think I'd want to sell if I was a shareholder. I think for me, it would have to be getting kind of closer to £3 to consider it. It would need to be valuing it kind of where it was before this little wobble, because I do think it is just a wobble.
Yeah. Yeah, yeah. Fair enough. Okay. Shall we move on to our US company, Workday?
Yes, so I think it is a company we've covered before, but not for a while. And we covered Kainos Group, which is UK listed last week, which basically is pivoting to kind of piggyback off Workday's growth, really. So we thought it was worth having another look at Workday. So for anyone who's not familiar with Workday, Workday is it's US listed, but it's a cloud-based software program for human resources designed to simplify workforce management. You can use its products to handle payroll, scheduling, employee onboarding, time tracking, learning, talent management, and performance evaluations. So anything to do with HR, really, you can use Workday as a system for, which I think for a lot of larger companies is probably they probably would. Now, if you've got 5 people, you're not going to use it, but I think if you've got a decent sized organization, it maybe is something that would be quite interesting. Additionally, it offers thorough reporting and analytics to support budgetary compliance and workforce planning choices. You can hire, manage, and involve your staff using Workday across the whole employee lifecycle. I think as well, I guess I know it's just HR, but there's probably a lot of add-ons as well they could potentially add that if you got someone in the system, they might be quite likely to take up on, and it's going to be quite high margin stuff. So Workday is used by more than 10,500 businesses around the world and across industries, and it's used by more than 60% of the Fortune 500 actually, which does kind of indicate it's more suited for medium to large size businesses. So Workday, quite convenient actually, came out with their third quarter results last week, which is quite coincidental really, because that was. Although I guess I wonder if Kainos Group have tied in their reporting with Workdays. Although a lot of these companies do report around the same time anyway. But yeah, they've come out with third quarter results, and all these figures will be in dollars. Total revenues were 2.16 billion, which was an increase of 15.8%. Subscription revenues were 1.959 billion, an increase of 15.8% as well, which makes sense given that virtually all of the revenue is subscription revenue. Operating income was 165 million or 7.6% of revenues, compared with 4.7% of revenues in the same period last year. Non-GAAP operating income was 26.3% of revenues compared to 24.8% last year. Diluted net income per share was 72 cents compared to 43 cents last year, and the non-GAAP diluted earnings per share was $1.89 compared to $1.56 last year. 12-month subscription revenue backlog was 6.78 billion, up 15.3% from a year ago, and the total subscription revenue backlog was 22.19 billion, increasing 20.3% year over year. Operating cash flows were 406 million compared to 451 million for the prior year. Free cash flows were 359 million compared to 391 million for the prior year. Workday repurchased approximately 600,000 shares of Class A stock for 157 million as part of its share repurchase program. Cash equivalents, and marketable securities were 7.16 billion as at October 31st, 2024. And Workday unveiled Workday Illuminate, the next generation of Workday AI, at its annual customer conference, Workday Rising. It also introduced a set of new AI agents and a new Workday assistant to streamline and simplify common HR and finance processes. And they closed the acquisition of leading AI native document intelligence platform, Evisort. They provided guidance for the 2025 fourth quarter, which ends 31 January 2025, of subscription revenue growth of 15% and a non-GAAP operating margin of 25%, and for the full year of subscription revenue growth of 17% and non-GAAP operating margin of 25.5%. In terms of the valuation, business trades at a P of 41, has a market cap of 67 billion and a price to free cash flow of 28. So in terms of free cash flow, it's a bit better than the earnings. But even still, for a $67 billion business, it is expensive. That being said, it's putting up good results. I imagine it's quite sticky in terms of a lot of it's subscription based, and it's the kind of thing where to move over to a different system for a company of that size is incredibly difficult and takes a lot of time. You've got to really dislike it to move, basically. So a lot of those customers will basically be locked in. Revenue growth of 15%, probably still a decent amount of opportunity. If they've only got 60% of the Fortune 500, you'd think there's probably another 40% to go out, would be my view, because it's probably quite suitable for most large businesses. I think in terms of the valuation, although I think it looks like a quality business, I've never knowingly used the product. And I think there's probably a lot of add-ons as well. They could probably make extra revenue from. Once you've got people in that system, there's probably lots of ways to make money out of them, in fairness. But I think at a price of free cash flow of 28 for a business that's already of that size, there might be a really good opportunity. But Kainos Group was a lot cheaper last week. I think Kainos Group probably has more opportunity because I suspect they're more saturated in the US than in the UK. I'd need to do some more digging into what exactly the nature of Kainos Group's relationship is with Workday and how vulnerable they are to Workday having a falling out with them. But I think my initial thoughts on Workday is, although it looks like a quality business, I don't think I'd want to pay 28 times free cash flow for it. But I think for Kainos Group, I don't think there's anything in here that would put me off having another look at Kainos Group, which could be more interesting. What about you, John?
I mean, I think it looks like a fantastic business. And as you say, very sticky, still a lot of room for growth. Difficulty is coming to the valuation really, and it's very expensive. So I think for that reason, I wouldn't be investing, but I certainly think it looks fantastic, and obviously it can't help its own valuation.
What do you think of Kainos Group having had a look at this then in
Oh,
terms of the product they're trying to sell? And
yes,
also their P
yeah,
is only about 17, I think, from memory from last
yeah.
week.
I think I would. I think I'd probably rather own Workday because that is what the most exciting part of Kanos is coming from. And I wouldn't really like to have the potential for any sort of falling out and losing that from Workday. That would be my
So
worry.
in that case, of the six businesses we've covered this week, JD Sports, Airtel Africa, Imperial Brands, Pershing Square, Direct Line, and Workday, which do you like the most and which do you like the least?
I think I would have to go for Airtel Africa as my first choice. And it's difficult. It's difficult. I'd maybe say Pershing Square. I probably would rather. I know I'm not criticizing Bill Ackman at all, but I'd probably just avoid that active fund, I think.
So I'm going to sound quite boring, but I would also go with Airtel Africa, as reflected by the fact it's the only one that I own. I don't think there's any terrible businesses in here this week. I think they're all pretty solid businesses. I'd probably put Pershing Square last as well, just because I'm not really interested in actively managed funds. That's Bill Ackman is one of the best fund managers there is. I think his track record has proven that. It just doesn't interest me. I just find it interesting to keep an eye on what he's actually up to and what he's been doing because he is quite interesting to follow. But yeah, I wouldn't ever consider it as an actual investment, I don't think. I think if I was to actually, I think I'd probably be more likely, if I did want an actively managed fund, I think I'd probably go with Terry Smith over Bill Ackman anyway, in all honesty. But
Thought you
um,
might say that.
if someone told me that I had to go on a desert island for 10 or 15 years and my money was going to be managed by Bill Ackman in the meantime, I wouldn't be terrified of looking at my portfolio when I got back. Let's put it that way. I'd be quite comfortable on the island.
Good to know. Okay, well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.